Hey there, deep divers. Have you ever thought about why some companies just seem to dominate their industries year after year? What's their secret? What is it? Today we are going to dive deep into that very question. We're talking economic moats.
Ooh, exciting.
I know, right? So we're going to unpack a fascinating report from Morgan Stanley.
Okay.
It's called Measuring the Moat.
Okay.
It came out October 15th, 2024. And it's full of insights about how companies can build and maintain that kind of competitive edge. Think back to the rise of Netflix.
Mm-hmm.
They went from mailing DVDs to completely changing how we watch movies and shows. Blockbuster, the once mighty king of rentals, just couldn't keep up. That, my friend, is the power of a strong economic moat.
It's a classic example of how a company can create so much value for its shareholders over the long haul. And at its core, that's what an economic moat is all about. It boils down to consistently earning a higher return on their investments. That's their return on invested capital, or ROIC, than the cost of that capital, known as the weighted average cost of capital, or WACC.
Okay, I'm following so far, but can you break that down for me a little more? I'm all about making these financial concepts super relatable for our listeners.
Absolutely. Imagine you're starting a lemonade stand.
Okay.
You invest in lemons, sugar cups, and maybe even a cool sign.
Yep.
That's your invested capital. The money you make from selling that lemonade after covering your costs is your return. If you're earning a good profit, your ROIC is higher than your costs, meaning you've built a profitable little lemonade empire.
I love it. So in the Blockbuster versus Netflix showdown, Netflix basically figured out how to make a way better lemonade stand. They offered convenience, no late fees, and a huge selection, all for a flat monthly price. Blockbuster's lemonade was suddenly looking pretty sour.
Exactly. Blockbuster couldn't adapt to the changing expectations of consumers. This brings us to the idea of expectations investing. Stock prices aren't just about what's happening now, they reflect what investors believe a company will earn in the future. When Netflix disrupted the market, investor expectations shifted dramatically, and well, we saw what happened.
So it's not just about selling a good product or service today, it's about having a strategy that keeps you ahead of the curve and exceeding those future expectations. This report actually dives into how companies in various industries, from airlines to tech, grapple with these dynamics.
That's right. And this is where strategy becomes crucial. It's not just about being in the right industry, it's about making smart choices as a company and having the right leadership in place. Our report breaks down a company's performance into three key factors: the industry itself, company-specific actions, and the impact of leadership, like the CEO.
So it's kind of like a basketball coach versus a soccer coach. They might both be amazing, but their skills don't necessarily transfer to a different sport. Are you saying some CEOs are better suited to certain industries?
That's a great analogy, and the research actually shows that a company's specific actions and its leadership have a much bigger impact on value creation than the industry alone.
Wow, that's surprising. I always thought the industry was the biggest factor. So we've got strategy leadership, and what else should we be thinking about?
Well, here's a thought-provoking idea. Industries, just like companies, go through life cycles: introduction, growth, maturity, shakeout, and decline. Most companies we see are in the growth or maturity phases.
Okay, that makes sense. So mature industry is like a seasoned pro, while a declining industry is, well, fading into retirement. But here's where it gets interesting. The report says that the average company in decline is still showing some sales growth, even though they're losing value overall. How is that even possible?
It's a fascinating paradox, isn't it? They might be selling more, but their costs are rising faster, or they're facing intense competition that's eroding their profits. And remember, companies can actually move back and forth through these stages. It's not always a one-way street to decline. A smart company can find ways to reinvent itself and jump back into a growth phase.
Okay, I'm starting to see how dynamic all of this is. So if we want to understand a company's potential, we need to know where they stand in their industry's life cycle and how well they're executing their strategy. What else should we be looking at?
To really analyze an industry, we need to consider what's known as Porter's Five Forces. It's a framework for understanding the competitive dynamics at play: the threat of new companies entering the market, the intensity of competition among existing players, the bargaining power of suppliers, the bargaining power of buyers, and the threat of substitute products or services.
Whoa, that's a lot to consider. It sounds like a battlefield out there. Companies are fighting on multiple fronts against new rivals, existing competitors, demanding customers, and even the threat of someone coming up with a totally different solution.
Exactly. Think of it like a game of strategic chess. Companies need to be thinking several moves ahead to stay in the game. Let's take the airline industry as an example. When we analyze where the profits are actually being made or lost, it turns out airlines often destroy value overall.
Wait, what? I always thought airlines were raking in the cash with those expensive tickets and baggage fees.
It's a common misconception. The reality is that the airline industry has really high barriers to entry. You need a ton of capital to even start an airline. Then there's fierce competition between existing players, which drives down fares. Add to that the volatile cost of fuel and the power of travel agents and online booking sites, and you've got a recipe for razor-thin profit margins, if any at all.
Okay, I'm getting a whole new perspective on flying now. So even though it seems like a glamorous industry, the underlying economics are actually pretty tough.
Exactly. And this is where understanding those five forces becomes so important. It helps us see beyond the surface and understand the deeper competitive dynamics at play.
This is fascinating. But I'm curious, if those barriers to entry are so high, how do new companies ever break into these industries? I mean, look at Uber and Airbnb. They completely changed the game.
That's a great point, and it brings us to the concept of disruptive innovation. Clayton Christensen, a renowned business scholar, developed a model to explain how these game changers enter the market. They often start by serving overlooked or less demanding customers at the low end, offering a simpler or cheaper solution.
Like those little mini-mill steel companies we talked about earlier, right? They started small, serving a niche market, but then they gradually innovated and improved their processes to the point where they could compete with the big steel giants. It's like a classic underdog story.
It is, and here's the counterintuitive part. Established companies often ignore these disruptors at Prince because they seem insignificant. But by the time they realize the threat, it's often too late.
So it's a cautionary tale for any company that thinks it's invincible. No matter how big or successful you are, there's always someone out there trying to build a better mousetrap, or in this case, a better steel mill or ride-sharing platform.
Exactly. And this brings us to another key question. How do companies actually create value, not just for themselves, but for their customers and suppliers? To understand this, we can use a tool called the value stick. It helps us visualize how a company creates value for itself and its customers and suppliers all at the same time.
Okay, I'm intrigued. I'm a visual learner, so I love the idea of a value stick. Tell me more.
Imagine a stick representing the total value created in a transaction. We can break this stick into three parts: the supplier's share, the company's share, and the customer's share. The supplier's share represents their profit, the company's share is their profit, and the customer's share represents the value they receive beyond what they paid.
So it's about understanding how much value each party is capturing in the deal, right?
Precisely. And this brings us back to those two important concepts: willingness to pay, WTP, and willingness to sell, WTS. Willingness to pay is the maximum price a customer is willing to fork over for a product or service, while willingness to sell is the minimum price a supplier will accept for their goods or services.
So it's like a negotiation, a dance between what the customer is willing to give and what the supplier is willing to take. And the company in the middle is trying to choreograph the whole thing to maximize their own piece of the pie.
Exactly. And great companies are masters at creating value by influencing both WTP and WTS. For example, they can leverage network effects where a product or service becomes more valuable as more people use it. Think about social media platforms like Facebook or Instagram. The more people join, the more valuable they become for everyone.
So it's like a snowball effect. The bigger it gets, the faster it rolls.
Exactly. Another strategy is working with complements. Think about video game developers and app stores. They rely on each other to create a more valuable ecosystem for users.
So it's about finding partners who can enhance your product or service and make it even more appealing to customers.
Precisely. And of course, there's the classic strategy of offering products or services that are just so good, so convenient, or so status enhancing that customers are willing to pay a premium. Think about Apple products. People line up for the latest iPhone, even if it costs more than the competition.
It's all about building that brand loyalty and creating a customer experience that people are willing to pay for. But it's not just about charming the customers right. Companies also need to build strong relationships with their suppliers.
You got it. By treating suppliers fairly and building collaborative relationships, companies can often reduce their willingness to sell, meaning they can get better prices or terms.
So it's a win-win situation. Happy suppliers, happy customers, and a happy company in the middle. I'm really starting to understand the power of this value stick concept. But we haven't even touched on things like government policies, the influence of brands, and how competition plays into all of this.
Those are all crucial pieces of the puzzle, and we'll be diving into them next time. Stay tuned.
Welcome back, Deep Divers. Last time we were talking about economic moats and how companies can build a sustainable competitive advantage. We talked about the importance of strategy, leadership, and even how industries, just like us, go through different stages of life.
Yeah, it's fascinating, isn't it?
It is so fascinating.
And, we still have so much more to uncover. We talked about the value stick and how companies create value not just for themselves, but for their customers and their suppliers.
Right.
But we also left off on this intriguing note of government policies, the power of brands, and the role of competition. Ready to dive back in?
Absolutely. I'm all ears. Where should we start?
Well, let's pick up where we left off. Government policies. They can be a real game changer for businesses. For better or worse, governments have a variety of tools at their disposal, like tariffs regulations, even industrial policies that can directly impact a company's cost competitive landscape and ultimately its profitability.
So it's like the government is the referee on the playing field, setting the rules of the game, and sometimes even stepping in to give a team a boost or maybe throw a penalty flag.
That's a great analogy. For example, think about tariffs. A government might impose tariffs on imported goods to protect domestic industries. While this might help some companies, it can also raise costs for others who rely on those imported materials.
Okay, that makes sense. So a company that manufactures clothing in the U.S. might benefit from tariffs on imported clothing because it makes their products more competitive. But a furniture company that relies on imported wood might see their costs go up, making it harder for them to compete.
Exactly. And regulations, while often necessary to protect consumers and the environment, can also add to a company's compliance costs. This is particularly true for industries like healthcare or finance, which face a lot of regulatory scrutiny.
Right. I can imagine navigating all those regulations can be a real headache for companies. It's like having to jump through a million hoops just to stay in business. What about those industrial policies you mentioned? How do they work?
Industrial policies are government initiatives aimed at supporting specific industries or sectors, often with the goal of stimulating economic growth or boosting national competitiveness. They can take various forms like subsidies for renewable energy companies or tax breaks for
So
manufacturers.
it's like the government is picking winners and losers in the economy. They're saying, hey, we think this industry is really important for our future, so we're going to give them a little extra help.
That's one way to think about it. Of course, these policies can be controversial, with some arguing that they distort the free market. But they can also play a crucial role in fostering innovation and supporting industries that are deemed strategically important.
Okay, I see how government policies add another layer of complexity to the whole economic mode equation. It's like companies aren't just competing with each other, they're also navigating a constantly shifting regulatory landscape.
Absolutely. And savvy investors and business leaders pay close attention to these political and regulatory trends because they can have a huge impact on a company's long-term prospects. Now let's switch gears and talk about something a little more glamorous, brands.
Ooh, okay, I'm ready for a little glamour. We all know brands can be incredibly powerful, but how do they actually translate into creating value for a company? Is it just about having a catchy name and a cool logo?
Not quite. Remember those two key concepts we talked about earlier, willingness to pay and willingness to sell?
Yeah.
Well, a strong brand can influence both of these. Think about a luxury car brand like Mercedes-Benz. They've built an image of exclusivity, quality, and prestige over decades. This allows them to charge a premium for their cars because customers are willing to pay more for the status and experience associated with the brand.
So it's not just about the car itself. It's about the feeling you get when you're driving a Mercedes. It's about the image you project, the statement you make. They're tapping into something deeper than just transportation.
Exactly. Their increasing willingness to pay by associating their brand with a set of values and aspirations that resonate with their target customers. But a brand can also impact willingness to sell. Think about a company like Google, known for its innovative culture and generous employee benefits. They attract top talent, often at a lower cost than competitors, because people are eager to work for a company with such a strong reputation.
So it's like a virtuous circle. A strong brand attracts top talent, which helps them innovate and create even better products and services, which further strengthens their brand.
Precisely. And that's why understanding how a brand contributes to increasing willingness to pay or reducing willingness to sell is essential when analyzing its true value and its role in building a company's economic moat. It's not just about being famous, it's about how that fame translates into tangible benefits for the business.
Okay, I'm getting a much deeper appreciation for the power of brands. It's more than just marketing hype. It's about creating real value that can make or break a company. But I'm curious, are there certain industries that are particularly good at building those strong brands and creating those economic moats?
That's a great question. Some industries, by their very nature, offer more opportunities for companies to build sustainable competitive advantages. For example, industries with high barriers to entry, like pharmaceuticals or software, can be attractive because it's difficult for new competitors to enter and disrupt the market.
Right. It takes a lot of time, money, and expertise to develop new drugs or create complex software programs. So if you're a company that's already established in those industries, you've got a bit of a head start, right?
Exactly. And if those companies can also build strong brands and establish themselves as leaders in innovation, they can really solidify their position and create durable economic moats. Think about companies like Apple, Microsoft, or Pfizer. They've all built incredible brands and leveraged their expertise to create lasting competitive advantages.
That makes sense. But I'm guessing that in industries with rapid technological change, it's a lot harder to build a moat, right? Like if you're a company that makes foot phones, you're probably not going to have much luck competing with the latest smartphones.
That's a great point. Companies operating in industries with rapid technological advancements like semiconductors or biotechnology have to be incredibly agile and innovative to maintain their competitive edge. It's a constant race to stay ahead of the curve, requiring heavy investment in research and development and a willingness to embrace new ideas.
It's like being a surfer riding a giant wave. You have to be incredibly skilled and adaptable to stay on top and avoid getting wiped out. So analyzing an industry's dynamics, its barriers to entry, its rate of innovation, and the competitive landscape are all crucial steps in identifying companies with the potential for long-term value creation.
Precisely. It's about looking beyond the hype and the headlines and understanding the deeper forces that shape an industry's evolution. And that's what measuring the moat is all about. Using a combination of industry analysis, company-specific insights, and a deep understanding of value creation to separate the true economic castles from those built on shaky foundations.
This has been incredibly insightful. I'm starting to feel like a true moat detective ready to solve the mysteries of the business world. But before we move on, I'm curious, are there any other key factors we should consider when trying to figure out if a company has a strong economic moat?
Absolutely. There's one critical aspect we haven't discussed yet, game theory. It might sound a bit academic, but trust me, it provides valuable insights into how companies interact with their competitors and make strategic decisions. Ready to play a game.
Oh, a game. I'm always up for a challenge. Bring it on. All right, deep divers, welcome back. We've been on quite the adventure exploring this world of economic moats and how companies can, create value not just for themselves, but their customers and suppliers too.
Yeah, it's been a really exciting journey, hasn't it? We've uncovered how, strategy, leadership, industry, life cycles, government policies, even the power of brands
A lot.
all play a role in building those competitive advantages. Lots of moving parts.
So many. And, I feel like I've learned a lot. I have this whole new perspective on how businesses succeed or, fail in the long run. But I have to admit, it's a lot to take in. Where do we even begin to apply these insights?
That's a great question, and that's exactly what we'll be diving into today. Let's distill some practical takeaways, whether you're an investor, you're looking for promising companies, or a business leader, you're trying to build a lasting advantage, ready to put all these pieces together.
Absolutely. Let's start with investors. What are some key things that they should be looking for when trying to identify companies with those, rock-solid economic moats?
Okay, first and foremost, focus on companies with a proven track record of earning high returns on invested capital, that ROIC we talked about. Remember, it's a key indicator of a company's ability to create value for shareholders. Don't just chase the latest hot stock or get swayed by short-term market hype. Look for companies with a history of consistent profitability even when the economy hits a rough patch.
So it's about looking beyond the flashy headlines and really digging into a company's financial performance over time. It's like checking their report card, not just for one semester, but for their entire school career.
Exactly. Next, pay close attention to a company's competitive position within its industry. Remember Porter's five forces, those competitive dynamics we explored?
Uh-huh.
Analyze the threat of new players entering the market, the intensity of competition among existing rivals, the bargaining power of suppliers and buyers, the threat of substitutes, how all these forces interact.
It's like a detective investigating a crime scene. You have to examine all the evidence, the suspects, the motives, the opportunities to figure out what's really going on.
Precisely. Look for companies that have effectively built barriers to entry, perhaps through strong brands, proprietary technology, a dominant market share. You want to see a company that's not just surviving, but thriving in its competitive environment, like a castle with high walls and a deep moat protecting itself from invaders.
So it's not enough for a company to just be in a good industry. They need to have a real edge, something that sets them apart and make it tough for others to replicate their success.
Absolutely. And don't underestimate the importance of a company's management team. Look for leaders who have a knack for allocating capital wisely, have a clear vision for the future, and are committed to creating value for all stakeholders, not just shareholders.
So it's about finding companies with strong leadership, a solid strategy, and a history of making smart decisions that pay off in the long run.
Exactly. And of course, let's not forget about the power of brands. They can be a company's most valuable asset. Strong brands can increase that willingness to pay from customers, reduce the willingness to sell from suppliers, and foster a loyal following that's hard to shake. Look for companies that have invested in building brands that resonate with their target audience, brands that stand for something more than just a product or service.
Okay, this has been incredibly helpful. I feel much more equipped now to analyze companies and separate those with true potential from those that might just be flashes in the pan. But what about business leaders? What are some takeaways they can use to build their own moats and achieve lasting success.
Business leaders can absolutely apply these same concepts to develop winning strategies. First, they need to get crystal clear about their company's value proposition. What makes their products or services stand out? How are they creating value for their customers, their suppliers, even their employees?
So it's about understanding what makes them unique, what they bring to the table that no one else can write.
Exactly. Once they've mailed down their value proposition, they need to focus on execution on making it happen. This means building operational excellence, streamlining their processes, creating a culture that's all about continuous improvement. It's not enough to just have a great idea. You have to be able to deliver on that promise consistently and efficiently.
So it's like a chef with a brilliant recipe. They need to be able to execute that recipe flawlessly every single time to create a dish that keeps people coming back for more.
That's a great analogy. And just like a chef needs to stay on top of culinary trends, business leaders need to embrace innovation. In today's fast-paced world, companies need to be constantly adapting, exploring new ideas, and investing in research and development to stay ahead of the curve.
It's about being willing to experiment, to try new things, and to constantly challenge the status quo. If you're standing still, you're falling behind.
Precisely. And just as investors look for companies with strong management teams, business leaders need to cultivate a culture that attracts and retains top talent. Empower your employees, give them opportunities to grow, and foster a sense of shared purpose.
So it's not just about building a moat around your company, it's about building a moat around your people too, right?
Exactly. By investing in your employees and creating a positive, supportive work environment, you're creating a competitive advantage that's hard to replicate.
Wow, this has been such a valuable deep dive. We've explored the ins and outs of economic moats from the fundamentals to practical takeaways for both investors and business leaders. What a journey.
Yeah, we've covered a lot of ground, haven't we? We've seen how to measure the strength and sustainability of a company's competitive advantage by analyzing its return on invested capital, its strategic positioning within its industry, the impact of government policies, the power of brands. We even touched upon the fascinating world of game theory, highlighting how strategic decision-making can make or break a company's success.
It's been incredible, but before we wrap up, I'd love to leave our listeners with a final thought to ponder. We've talked a lot about how companies build economic moats, but how can you, the listener, build a personal moat? What unique skills, knowledge, or experiences can you develop that make you indispensable in your own career?
That's a great question. We encourage you to reflect on your own strengths and aspirations. Think about what sets you apart, what makes you valuable, and how you can continuously learn and grow to build your own personal moat for lasting success.
So it's about investing in ourselves just like companies invest in their businesses.
Exactly. By constantly honing our skills and building our network, we can create a competitive advantage that's uniquely our own. Until next time, keep diving deep and keep building those moats both for your companies and for yourselves.